Greetings everyone, I'm James. It's currently 6 a.m. Eastern Time on April 14th. If you haven't been keeping up with the news over the weekend, let me just fill you in and update you on what's transpired over the past 72 hours. First, no agreement was reached between the two parties. However, U.S. officials subsequently revealed that contact between the two delegations is still ongoing, not to discuss a specific agreement, but rather to discuss whether negotiations can be resumed. And second, in response, Mr. T announced a blockade of the Strait of Hormuz. Yes. West Texas Intermediate crude oil surged by over 8.6% at one point yesterday, briefly reaching the $105 mark. And although some profit taking occurred later in the session as prices hovered at elevated levels, the price subsequently retreated to a trade range bound near $103. Brent crude strengthened in tandem, and global energy prices saw broad-based gains. And third, what happened with gold yesterday? Well, geopolitical conflicts escalate, oil prices soar, and according to textbooks, gold should surge. Yet, spot gold opened yesterday with a sharp plunge, plummeting by over 2% at one point. It dropped from last Friday's historical high of $4,856 to a low of $4,648. It dropped by more than $100. It dropped from last Friday's historical high of $4,856 to a low of $4,648. Basically, it dropped by more than $100 in one day. Now, fourth, let's talk about NVDA. Okay, NVDA. Today, we'll dedicate a specific segment to dissecting this particular stock. What exactly is the market currently repricing? Well, today, we will clearly explain 4 key points. Additionally, there is a certain in-depth data that I will not fully elaborate on during this public live broadcast. Specifically, my analytical projections regarding the interplay between oil prices, gold, and U.S. stock indices under a Strait of Hormuz blockade scenario. The complete version is available through my assistant, and I'll let you know how to access it shortly. So let's get started. Part 1, US-Iran negotiations, no agreement, but not over yet. Let me start by mentioning a detail that many people have overlooked. Although the negotiations in Islamabad failed to produce an agreement, US officials explicitly stated that contact between the US delegation and Iranian leaders remains ongoing. One official even remarked that progress is currently being made in efforts to reach an agreement. What does this signify? Well, this is not a diplomatic rupture. No, this is not a severing of diplomatic ties. No, it is a conditional contact under extreme pressure. The channels for communication between the two parties have not been closed. Even as Trump moves to blockade the Strait of Hormuz, Larry Kudlow, the director of the White House National Economic Council, has stated that dialogue between the US and Iran is not entirely futile. So, my thoughts, well, the market has already fully priced in the breakdown of the weekend negotiations. Yesterday's wild swings in oil prices surging 8% before retracing to a 3% gain indicate that capital is currently engaged in the first round of pricing for the Hormuz blockade scenario. However, this process is not yet complete. This is because no one knows how long such a blockade might actually last. So, my question to you, what do you think? Do you believe a blockade of the Strait of Hormuz would persist for more than 1 month? Give me a yes. Give me a 1 for yes. Give me a 2 for no. Now, let's go on. Oil prices. Let's talk about oil prices. After breaching the $100 mark, the Fed finally begins to get anxious. So yesterday, crude oil briefly broke the $100 per barrel and subsequently dipped back below that threshold and is currently oscillating around the $96 mark. Note that the magnitude of this volatility is sharp 8% surge, followed by a retracement to a 4% gain. This is not being driven by a supply and demand fundamentals, but rather by violent swings in the market sentiment and risk premiums. Now, more importantly, the Federal Reserve has finally begun to weigh in. Yesterday, Chicago Fed President Austin Goolsbee made a highly significant statement. He noted that current pricing in the oil futures market reflects an expectation that any surge in oil prices linked to a potential conflict with Iran would be transitory. He then uttered a sentence that I have listened to and replayed several times. If gasoline prices were to remain at these elevated levels or climb even higher for a prolonged period, we would then have to reevaluate what that implies for consumer spending. So, in plain English, this translates to the Federal Reserve is currently operating under the assumption that any rise in oil prices will be short-lived. But what if it isn't? In that scenario, the entire policy framework would require a complete recalculation. So, my thoughts, current oil market pricing has not yet fully factored in a scenario where the Hormuz blockade persists for 3 months. If the blockade of the Strait of Hormuz were to last longer than 6 weeks, West Texas Intermediate crude would not merely hover the $100 to $105 range. It would surge toward the $115 to $120 level. And this is because approximately 20 million barrels of crude oil, representing a massive share of global supply, pass through the Strait of Hormuz every single day. A supply shock of this magnitude has not been witnessed since the 1970s. So, questions for you. Do you believe that the West Texas Intermediate crude will firmly establish itself above the $110 barrel, will firmly establish itself above the $110 per barrel mark by the end of April? Give me a 1 if you think so. Give me a 2 if you think not. And let's talk about gold. Down $100 in a single day. Who is selling? Yesterday's movement in gold prices represents the puzzle that demands the most deconstruction today. Last Friday, gold prices touched a new all-time high of $4,856.93. Yet, after a mere weekend passed, gold prices plummeted right at Monday's open. During intraday trading, the price briefly crashed by over 2%, hitting a low of $4,648.65. Now, according to conventional logic, with escalating conflicts in the Middle East and surging oil prices, gold ought to be rising. But this time, things are different. Why? Well, my thoughts, someone is being forced to sell gold to meet margin calls elsewhere. So, the surge in oil prices has triggered margin calls on energy-related derivatives, compelling holders of long gold positions to liquidate those holdings to plug the resulting gaps. Now, this does not signify a failure of gold's safe haven logic, but rather a liquidity squeeze. Gold remains a safe haven asset. However, in the short term, it is being dragged down by the margin requirements of other risky positions. So, this illustrates one crucial point. When the market volatility spreads from a single focal point to the broader market across all asset classes, cash and only cash is the true safe asset. So, my question to you is this: do you believe gold will climb back above $4,800 this week? Give me 1. If yes, give me 2. And now, let's talk about NVIDIA. 8 consecutive days of gains, yet still range-bound. AI hardware is being repriced. NVIDIA warrants a separate, dedicated analysis today. This is because over the past week, it has strung together its longest winning streak in over 2 years. Its share price has still failed to break out of its trading range. And this conveys a critical message that the market is sending you. So, first fact, 8 consecutive days of gains, and yet the trading range remains unbroken. NVIDIA closed higher last Friday, marking its 8th consecutive trading session of gains. Its longest winning streak since November 14th, 2023, when it rose for 10 straight days. Its overall gain of 6.34% last week certainly looks impressive. However, here's the catch. Isn't there always a catch? During the same period, the S&P index has also been rallying for several consecutive days. More importantly, for months now, NVIDIA's stock price has been oscillating with a narrow band between $165 and $195, consistently failing to break out of this specific range. Now, last Friday, the stock touched a high of $190 before closing at $188.63 by Monday's pre-market session. It had retreated to the vicinity of $186, and consequently, the stock's failure to break through the $190 threshold on Friday and its subsequent pullback was no mere coincidence. as $20 billion in mechanical buying flows into US equities only to collide with the reality of high interest rates for the long haul. A scenario defined by economist Bill Williams, NVIDIA's valuation math may well be teetering on the brink of collapse. But from a technical perspective, the message is clear. Despite rallying for 8 consecutive days, the stock failed to even graze the $200 mark. Does this signal underlying strength, or is it merely the last gasp of a spent force? My thoughts, it represents a textbook case of buying interest exists, yet momentum for a breakout is lacking. Because buyers are present, but no one is willing to push the price past the critical resistance level. And here's the second fact. The stock's valuation has reached its lowest level in recent years. According to the latest trading data from April 10th, NVIDIA's trading volume for the day surpassed $30 billion. Ranking it first among US equities and marked a significant 37.82% increase compared to the previous trading session. However, what warrants even closer attention is its valuation. The forward PE ratio, which is based on estimated earnings for the next 12 months, stands at approximately 20x. Now, this figure is substantially lower than its 10-year average of 36x, positioning the stock at a relatively low valuation compared to other large cap technology stocks. Some analysts characterize its current valuation as trading at 22x forward PE with a PEG, price to earnings to growth ratio, of 0.74, the cheapest level seen in years. While Tigress Financial continues to maintain a price target of $360, according to Guru's Focus GF value model, NVIDIA's intrinsic value is calculated at $307.80 per share, and this suggests that based on the current trading price of $188.63, the stock may be undervalued by approximately 38.7%. Now, here is a stock that has rallied for 8 consecutive days and continues to demonstrate high revenue growth, yet its valuation sits at a historical low. So, what exactly is the market afraid of? Well, let's go to the third fact. GPU, graphics processing units, rental rates are on the rise, indicating that the demand remains red hot. Yesterday, April 13th, the latest data from Orn, a New York-based data provider, revealed that the spot rental rates for NVIDIA's high-end Blackwell series chips within cloud data centers have skyrocketed to $4.08 per hour, and this represents a 48% surge compared to the rate of $2.75 per hour recorded just 2 months ago. And this constitutes the most authentic signal of genuine demand. It is not about what analysts say, nor what financial reports indicate. Rather, it comes down to how much customers are willing to pay to lease NVIDIA's computing power. A 48% surge in revenue growth points to one thing: demand for AI computing power has not cooled off. On the contrary, it's accelerating. So why isn't the stock price rising? Let's go to fact number 4. The production bottleneck for the Rubin series is real, but the market may have overreacted. On April 7th, KeyBank analyst John Vin confirmed, following an investigation into the Asian supply chain, that NVIDIA's production target for its next generation Rubin GPUs has been lowered from the originally projected 2 million units to 1.5 million units. The primary reason for this downward revision is delays in the certification and supply timelines for HBM4 memory from SK Hynix and Micron. Currently, shipment forecasts for the Vera Rubin rack systems have also been cut from an estimated 12,000 to 14,000 units to approximately 6,000 units. However, there is another side to the coin. NVIDIA has largely secured its supply chain for advanced COWOS, basically chip on wafer substrates, packaging. However, there is another side to the coin. There always is, right? NVIDIA has largely secured its supply chain for advanced chip-on-wafer substrate packaging. So chip-on-wafer substrate packaging capacity is projected to reach 650,000 wafers in 2026, a 76% year-over-year increase, and is expected to expand further to 840,000 wafers in 2027, representing a 29% year-over-year growth. In terms of product mix, the chip-on-wafer-on-substrate packaging capacity available in 2026 remains sufficient to support the production of approximately 5.5 to 6 million Blackwell GPUs, 1.5 million Rubin GPUs, and 1 million Hopper GPUs. Blackwell is stepping up to fill the void. Research by TrendForce indicates that due to the delays affecting Rubin series, the Blackwell series share of NVIDIA's high-end GPU shipments in 2026 is projected to surge significantly from 61% to 71%, and thereby further solidifying its market dominance. And while the Rubin launch has been postponed, Blackwell is effectively bridging the gap. Consequently, the year-over-year growth rate for NVIDIA's overall high-end GPU shipments saw only a marginal downward revision from approximately 26.8% to just under 26%, indicating a very limited impact from the adjustment. And now, KeyBank has maintained its overweight rating on NVIDIA, setting a price target of $275 based on the view that the delays in HBM supply will have a negligible impact on long-term demand. Let's go on to fact number 5. The two most significant warning signals. Short sellers are moving in, and insiders, well, they're selling off their shares. And renowned short-selling investor Michael Burry recently disclosed that he has increased his holdings of NVIDIA, but he has increased his holdings of NVIDIA put options with a January 27th expiration and a strike price of $115, drawing parallels between the current AI boom and the dot-com bubble of the past. Meanwhile, over the last 90 days, NVIDIA insiders have collectively sold off approximately 1.2 million shares. Short interest has also risen by about 22.5% during the same day 90 period, with current short positions standing at roughly 280.9 million shares. So, some of my thoughts: NVIDIA stands at a crossroads today. Fundamentals strong, demand for Blackwell chips, a 48% surge in GPU rental rates, and fully booked COWO chip-on-wafer substrate capacity point toward an upward trajectory. However, technical indicators, the stock has been range-bound between $165 and $195 for months, consistently failing to break past the $200 mark, along with risk signals. Short seller targeting and insider selling point toward uncertainty. The market is currently conducting a referendum on NVIDIA regarding the question: is AI spending sustainable? The answer relies not in today's share price, but rather in the direction of oil prices post April 24th, and in the capital expenditure guidance provided by hyperscale customers during the May earnings season. So, question for you: do you believe NVIDIA will break above $200 or fall below $170 before its May earnings report? Give me a 1 for a breakout above 200. Give me a 2 for a drop below 170. And now, earnings season officially kicks off today. Banking giants lead the charge. Today marks the first day of earnings season. Financial institutions such as JP Morgan Chase, Wells Fargo, and BlackRock are scheduled to release their first quarter results today. Market consensus projects JP Morgan Chase's adjusted earnings per share to be approximately $5.46, while the S&P 500's overall earnings growth rate is expected to reach 12.6%. However, there is a critical caveat: the impact of surging oil prices and the imposition of 125% tariffs will not be reflected on these first quarter earnings reports. The first quarter concluded at the end of March, whereas the potential blockade of the Strait of Hormuz and its subsequent market impact did not begin until April. Consequently, regardless of whether today's bank earnings reports appear strong or weak, they cannot serve as a reliable indicator of the conditions to be expected in the second quarter. My thoughts: The true focal point of today's earnings reports lies not in the raw numbers themselves, but rather in the forward-looking guidance provided by bank management teams regarding their outlook for the second quarter. If Jamie Dimon from JP Morgan Chase starts talking about geopolitical risks dampening loan demand during an earnings call, that is the real signal. So some of my overall thoughts. What I'm watching pre-market today, once the market officially opens today, I'll be keeping a close eye on three things. The divergence between energy and tech sectors. If energy stocks rally by more than 3%, while tech stocks drop by more than 2%, constitutes a classic geopolitical rotation. The strength of gold's rebound, if gold prices quickly reclaim the $4,750 level during today's trading session, it suggests that yesterday's sharp decline was merely a liquidity shock and that safe haven demand remains intact. Conversely, if it continues to drift lower, slipping below $4,600, it indicates that capital is being withdrawn on a much larger scale. NVIDIA's performance around the $190 mark. If after the open, the NVIDIA falls to hold above NVIDIA's performance around the $190 mark. After the open, NVIDIA fails to hold above $188, it suggests that the momentum from its 8-day winning streak is beginning to wane. However, if it breaks through $190 on heavy volume, that would be a completely different signal. Now, I know that some of you in the comment sections are already asking, so what should I do with the gold energy stocks or NVIDIA shares that I'm holding? Or what about oil prices this high? What should I be holding onto my positions? And I cannot answer these types of questions directly during a public live stream, simply because everyone's portfolio holdings, cost basis, risk tolerance are all very unique and different. So instead, just please reach out directly to my assistant, provide her with your stock tickers and a rough overview of your position sizes, and she will compile the details and forward them on to me. And then I'll provide you with a personalized assessment via a private message. Now, let's continue. All right. That wraps up my pre-market outlook for today. So finally, here are three things I can do for you right now. First, hit that notification bell. I will be going live at 10 a.m. sharp to provide real-time market analysis, interpreting the actual signals emerging from the market as they first hit that notification bell. I'll be going live at 10 a.m. sharp to provide real-time market analysis, interpreting the actual signals emerging from the open as they happen. If you don't enable notifications, you'll miss out. And second, my assistant's contact deals are displayed at the bottom of your screen. You can find her contact info in the video description below. Remember to enter today's access code APR14PRE, and my assistant will then add you to my exclusive analysis group. And once the market opens today, I'll be posting two items in that group: a hand-drawn chart illustrating my projected asset correlations in a Strait of Hormuz blockade scenario, and a technical analysis chart specifically for NVIDIA with the $165 to $195 trading range. And members of the private group will get to see this content before it's released to the general public via live stream. And third, if you would like to access all the key data points I mentioned today, including the timeline of diplomatic engagements following the breakdown of US-Iran negotiations, the projected trajectory of oil price fluctuations, a comparative chart of production capacities for NVIDIA's Blackwell and Rubin architectures, and my forward-looking outlook for various banks during the current earnings season, simply reach out to my assistant to request them directly. It's completely free. And remember this, when gold and oil prices move in opposite directions, the market is signaling that when gold and oil prices move in opposite directions, the market is signaling to you that liquidity takes precedence over safe haven demand. And conversely, when NVIDIA rallies for 8 consecutive days, yet fails to break out of its trading range, it tells you that a significant chasm exists between market confidence and actual valuation. So stay sharp, stay humble, and never mistake a temporary spike for a permanent shift. I'm James. Contact my assistant and I'll catch you during the market hours.